Good morning. Welcome to the office panel. I'd like to introduce our panelists. We have Todd Doney, Jeff Pion, Rick Sherburne. Looking forward to a great panel this morning. I'd like to start out with a macro level question. Jeff, you're one of the most active brokers in Los Angeles. Can you give us kind of a big picture overview of the Southern California leasing market?
I think we had a very good year last year. You know, the last 3 to 4 years have been somewhat slow. Last year in Southern California was a very strong year for us. Los Angeles and Orange County, also a very strong year. Perhaps not quite as robust as some of the other markets that we're seeing in California. For example, South of Market in San Francisco had almost a 51% rent increase over the last 2 years. We've seen other places like Mountain View in Silicon Valley with almost a 42% rent increase. In Los Angeles, our rent increased about 9 to 10% last year. Different submarkets have responded differently. But I think overall we're very positive about where the market is today and where it's going.
Thanks. Now that we have kind of a big picture overview, let's drill down into some specific markets. Rick, we've seen the vacancy rates drop pretty precipitously in Orange County, but we haven't seen rental rates increase during that same kind of past few year period. Why do you think that is?
You know, I think that's a really good question. I think if you look at the Orange County marketplace, it's a 100 million square foot market. 70% of that market is in the John Wayne Airport, South County market. And if you look at the overall vacancy that peaked at 18% in late 2010, vacancy dropped all the way down to 12.5% in end of last year. Rental rates peaked at $2.75 a foot during that same period of time and has fallen to a trough of about $2 a foot. Over the last 4 years, we've had tremendous, robust, positive absorption of about 5.5 million square feet. You would think with that type of absorption, with a 12.5% vacancy, you'd have rent growth. Two primary reasons. One, we had a recycling of the ownership. We had .com, .bomb, we had a mortgage industry that fell apart. We had a lot of debt on assets that were greater than the value of those assets. We had tenants moving out of those assets. We had zombie buildings that couldn't do leases. And so we had a lot of issues fundamentally within the portfolio in the entire market. The biggest reason is the Irvine Company. The Irvine Company has 18 million square feet in the market. That represents 25% of our entire market. They lead the market up, they lead the market down, and they lead the market flat. And that's exactly what they did. They led the market flat. They didn't focus on rent growth. They focused on retaining their occupancy and gaining market share. And in fact, today, their occupancy of that 18 million square feet is 95%.
And let's go further north up to the Tri-Cities area, which you're more than familiar with. You did several large transactions in the Glendale area last year. Tell us a little bit about those and what impact they had on the Glendale market.
Sure. So, Glendale struggled for the last several years. So last year was a really good year for Glendale, most notably Nestle renewed their corporate headquarters for 400,000 square feet. We looked at a lot of scenarios for that company before we made a commitment to stay. Had they left that marketplace, the vacancy would have gone up by 36%. It would have gone from mid-teens to low 20s just by that relocation. So that's a good validation for the market. Cigna renewed for 80,000 feet, and then a little smaller deal, but interesting to note, was Avery's relocation from Pasadena to Glendale. Avery had been in Pasadena for decades, and actually after selling their corporate campus wanted to stay in the Pasadena marketplace, but at the end of the day they could save a few $1 million, move to a relatively new building in Glendale, put their name at the top of the building, get some good identity, and I think all those deals for Glendale reflect sort of a validation of that market as a good location for corporate America.
And speaking of very large transactions, Jeff, you represented Hudson Pacific on their lease with Riot Games out at Element LA, which I believe was the largest new lease in Southern California last year and one of the biggest ever in that particular market. What was unique about that deal, and why do you think Riot chose to have Element LA as their headquarters?
I think Riot's goal, and the reason that they came to the Element LA project, was they are in Santa Monica, and it was very important to them to get a very unique campus feel. They wanted exclusivity, so they wanted to be sort of all by themselves, and they were negotiating a transaction down in Playa Vista that they'd been working on for quite some time. and I think that they had hit some roadblocks on that transaction. The Hudson folks really have a great eye and a great architectural aesthetic for what sort of the tech world wants today. They've been very active up in Seattle, very active in all the South of Market product in San Francisco. So I think that their team really understands sort of the technology media space today and what those tenants want. So with Element LA, they came in, and as many people know, that was sort of 5 or 6 very disparate buildings, red brick buildings, Bow Truss, but great bones. But in the middle of all those buildings was just a sea of asphalt parking. And it was very difficult for people to see what that could be. They hired Gensler, who did, with a couple of other consultants, a great park in the middle of all those buildings, and they decided to build a parking structure on the side of it. So you really had this very exclusive group of neat warehouse buildings, but this wonderful landscape central park, and I think that's what made it so interesting to Riot, as well as the rail that's coming out from downtown to Santa Monica. And as most people know, the rail will be done in 2016. There's a rail stop right at Bundy and Olympic, and I think that the Riot folks also, because that is a very congested area today, I believe that the rail is going to help make that a better place to be long term. So it was a great transaction to work on. Both people, both teams on both sides were really wonderful to work, and we got that deal done in about 2 weeks from start to finish, which is, you know, unbelievable for the size of the transaction.
Absolutely. Rick, you were involved in one of the largest leases in Orange County last year. Give us kind of the inside scoop on that deal and what impact that had on the Orange County market.
We were really fortunate to get hired by Clean Energy. Great client, fantastic people down there. You need to understand a little bit about the challenges that they had with their occupancy. They were occupying a project at Bixby Center in Seal Beach, right on the 405. Caltrans had started a 405 widening project that included taking 50 feet of their parking lot. It included demolishing a bridge, rebuilding a bridge. I think it lasted 4 years, all within about 100 yards of the CEO's office. Not a good scenario. It was an asset that needed capital, needed amenities, needed common area refurbishment, none of which got done. So they had 40,000 feet, they needed close to 80. So the solution really was, let's get close to the airport market, let's get productive with our employees, let's provide them some amenities they haven't had. They were in 8 suites in 3 different buildings. So really the perfect scenario for consolidation. The solution was we moved into an Irvine Company building, a MacArthur Court. It was a twin 16-story Class A's, 560,000 square foot project. The project was 68% occupied, so about 200,000 square feet of vacancy. So the Irvine Company had just completed a $4 million investment, everything from new cafes to fitness facilities to common area, elevator technology, Wi-Fi, and it was the perfect fit for them. Putting $4 million in an asset is a lot different than saying you're going to put $4 million in. So they pulled the trigger and signed a lease for just about 4 floors. At the same time, MSC Software signed 2 floors. So in the matter of a month, 110,000 square feet was pulled off the market. That building went from 68 to 90 in 1 month, and it was an inflection point. It was a turning point in the project. It was really a turning point in the Class A's that the Irvine Company had. They didn't have any large blocks of space. We saw the absorption slowly but surely over 3 years trickle, but that was actually an inflection point. The transaction at $1.26 net effective over 8 years with $53 in TIs, we can't get within $1 a foot of that anymore today. So I think clearly the flight to quality, the flight to amenities is what those clients are looking for today.
Let's shift north again to downtown. Todd, you've always been a big advocate of downtown Los Angeles, and we've certainly been reading over the past couple of years about all of the activity with the retail, entertainment, hotel, residential, and what a hot market downtown LA is for those sectors. Do you see any of that translating into increased office demand?
Oh, absolutely. And I've been down here for 30 years, and the perception of downtown and the activity going on has never been as significant. I mean, it's really exciting, and you go through, it's like it's firing on every cylinder, right? You go through the hotels, and I think there's 6,500 rooms now, and there's 1,200 under construction. So that's a 20% increase in hotel capacity. There's 25,000 apartment units, and there's 5,000 under construction now and another 5,000 contemplated. We've had some like 200 restaurants and 87 bars open up in the last few years in downtown LA. And the one interesting thing from the office perspective is historically, we didn't get much migration downtown. Once a tenant sort of moved out of downtown, they didn't move back here. And we can point to something close to 800,000 square feet of tenants that have migrated downtown from Santa Monica, Century City, Universal City, Pasadena, the South Bay. So that's a really great trend. And we still have a vacancy sort of in the mid-teens, but all of us working downtown are very excited about all these things going on and those trends.
And what particular submarkets within downtown, and maybe even which projects in particular, do you think will be most likely to succeed?
So in 2014, I think you'll continue to see South Park be interesting, a lot of residential going on there. The Arts District, which is the area sort of between the LA River, Alameda, 1st and 7th Street. I mean, there's a lot of institutional money chasing the creative office product in that market. I think Bunker Hill, you'll probably see a lot of activity in 14 and 15 on Bunker Hill for a couple reasons. It's where our big blocks of space are, and you have a couple of very large institutional owners who are committed to the market between Brookfield and CIM now owning 2 California Plaza. I think you'll see a bunch of activity up here on the Hill.
And so we think downtown may become or is becoming a hot market. Jeff, what are the hottest markets in terms of office demand in LA, and what are the industry drivers behind that office demand in those markets?
So I agree with Todd. I mean, there's a lot of excitement about downtown LA, and we've watched for many, many years, and there's been a lot of talk, and Staples Center opening, being active for 300 plus nights a year. This is the first time in my career that we're having those conversations with tenants on the west side about, well, what about downtown? And the industries that we're seeing, the growth industries are technology, media, and entertainment. And there's a number of other industries, law, accounting, public relations, advertising, that support, all of those other industries. But it's the convergence, I think, in our marketplace. We're all very fortunate to live in Los Angeles and Southern California and Orange County, that those 3 industries are converging, and you layer on top of that the technology and the software companies for the social media, the mobile technologies, cloud computing. While Northern California has been sort of the main bastion for all of those industries, we're seeing more and more of those companies down here in Southern California. On the west side, it's Playa Vista, Santa Monica, Venice, and Culver City. Those are the hotbeds. But it's not fair to take away from sort of the more established markets like Westwood and Century City and Brentwood, because I still believe that, at least in Los Angeles, because public transportation is still somewhat of a challenge, figure out where the CEO lives and draw a 3 to 5 mile radius, and that's usually where that company will choose to locate. I think the rail and the public transportation that we're going to have out to Santa Monica is going to change that a little bit. And I think when you look also at the demographics of downtown Los Angeles and the affordability of housing, I think you're going to see more and more people look at downtown as a place to either locate their business or a place to pull employees from, because the housing stock is actually very exciting.
What changes are we experiencing, and how are your clients going to adapt? Your tenants
Well,
adapt?
what we're seeing investors flock to Orange County. Last year in 2013, we turned over 5.5 million square feet of office space, primarily in the airport, South Coast Metro, and South County Marketplace. That represented about $1.2 billion in new capital. All those investors are betting on increase in rents. So what are our clients looking at? Our clients are looking at quite a likelihood of rents going up in the marketplace. They're going to have to deal with some real inflation in rents. With a 12% vacancy, there isn't any doubt that that's the direction that it's going.
Thanks. I think it's probably time to wrap up, but before we do, I'd like to get a forecast for 2014 from each of you. Let's start with Rick.
2014 is going to be a very solid year. We're going to see rent increases based upon a vacancy, based upon new investor that have invested money into their assets and amenitize those assets. They're going to get a return on that. We're going to see positive absorption based upon the estimated 20,000 new jobs that Orange County will receive. I think we're going to see some new creative approaches. I think you're going to see new product come online the latter part of 2014. And then I think you're going to see an increase in efficiency. I think tenants are going to look at their occupancy, they're going to look at being more efficient, they're going to lease less space as a result of it, but they're going to have a better environment to work in. And then last, I think I mentioned before, unemployment is going down. This is moving to an employee market, not an employer market. And I think tenants, by the end of this year, are going to look really seriously at what they're doing to attract and retain their employees. And I certainly know that space will be one of those solutions.
Thanks. Jeff?
2014 will be an exciting year. I think for the West Side, we've got great synergy with the technology companies. There's been some pretty significant changes with some of the landlords owning different properties. I think that's going to put upward pressure on rents. You're going to see landlords, I think, start to sort of try to push the needle a little bit as vacancy rates tick down. We had about a 6% reduction in vacancy rates from the beginning of last year to today. I think we forecast that going down some more in 2014. We had about a 9% rent growth in 2013 across most of Los Angeles. We've got spikes in some markets in Santa Monica, Playa Vista, Venice, and Culver City. But I think overall 2014 is going to show a lot of activity, a lot of tenants looking at things, a lot of capital still chasing this market because it's one of the most desirable places to invest in the United States. And there's going to be some very interesting things that I think are going to happen this year. So overall, I'm very bullish.
Todd, final thoughts?
I've always been the glasses half full type of guy, so I think 14 will be another great year. I'm encouraged by the job growth that you read about, that employers are starting to hire people. I'm encouraged by my clients committing to longer lease terms that they're comfortable with their business. I think the markets where I'm working have really been supply constrained, so I think you'll see some nice absorption numbers and vacancy declines over most of the markets that I'm working in.
Great. Great panel. Thank you. And we will see you again next year.
Thank you.